2019. So this one is a statement of assets, liabilities, and what? And capital. So we start by recording assets. Specifically, we record always. First of all, we record non-current assets. So for non-current asset, I think we have a number of them in the trial balance. You have to record that all assets have a debit balance, and I think we can start from where we have land and buildings. Land and buildings. So for added buildings, I hope you can see they are not depreciated. So for the value for added buildings remain the same as 90,000. Then below that we have tractors. We have tractors. Tractors, we are given their net book value as 32,400, but these tractors during the year they depreciated. They lost a value of 81. So we have to less that depreciation there, so that we get their net book value at the end. We are going to compute that. And then from there we have other cattle, which are bulls. So remember, these are still assets. Specifically under IAS 41, we refer to them as biological assets. Biological assets. So they have a value of 6,000. And then from there we have cats. Cats, we are given the value as what? As we are given the value as what? As 3,000. 3,000. So meaning that there is something we need to correct here. This value was not 6,000, but rather it was 3,000. 3,000. So let's make that small change here. We took the wrong figure, so meaning that we have 12% of 3,000. 3,000. So that will be, this will be 360. 360. So we can correct this, which will be 23,940 minus 720 plus 360. That will be 23,580. 580. So we less it from that figure up there, 49,000. So which will give us 25 for 20, and then minus 3,600. Yes, so this will be 21,820. Yes, so that should be the correct thing. So I've taken the wrong figure for cats there, 6,000 instead of 3,000. So that will be cats 3,000. So we less their depreciation here of 360. 360. Okay, so maybe you can just confirm whether we have any other item of non-current assets. Any other item of non-current asset in the trial balance, and I don't think so. So let's get now get the final figures here for these two assets, starting with tractors. Tractors, we have 32. We have 32,400 minus 8,100, which will give us what? Which will give us 24,300. And then we have cuts. We have 3,000 minus 320, which will give us what? 2640. 26 what? 40. 2640. Okay, I'm trying to counter check whether we have any other item. Any other item of non-current asset? I don't think so. Yes, so next we record current assets. We record current assets. So for current assets, what do we have here in the trial balance? We check the items on the debit side. What can I see? I can see cash at bank. Cash at bank, which is a figure of 15,300. 15,300. Yes, I think that is the only item we have in the trial balance. But now in the additional information number 1, we have the closing inventory. Closing inventory. So we have various items of closing inventory which include daily cattle. Daily cattle having a value of 54,000. We then have growing maize having a value of 27. We have other cattle which are bulls having a value of what? A value of 54. And then we have daily cattle feeds. Daily cattle feeds having a value of 1620. And then we have fertilizer for planting maize, which is 10 what? 1080. So those are the various items of closing inventory we have in note number 1. Note number 1, 1080, 16, 20, 54, 27, 54,000. Okay, number 2, number 3, number 4. Yes, so we don't have any other item of current assets. So what we need to do is to get the total assets. Let's get the total asset. We add all these particular assets we have here, starting from what we have here at an non-current asset. We have 90,000. We have the other item 24,3, 6,000 plus 26,40 plus 15,300, 300 plus 54,000 plus 27 plus 54 plus 1620 plus 1080. Yes, that will give us a total of 203,040. And then from there we record the financials, which include capital and what? Liabilities. So we start by recording capital, which is the first, actually not the first, but we have it in the trial balance as a figure of what? We have capital in the trial balance as a figure of 163,080. So to this, what do we add? We add the profit for the year. The profit for the year from the income statement, this one, which is 18 what? That is 21,820. And then to this, because this is a sole proprietorship business of David Wekesa, we less any drawings. And in the trial balance, we don't have drawings, but we have the information we have in note number 2 about the maize consumed by family members. We have said any farm produce consumed by the family member, we account for that as sales in the revenue account, and then we account for it as drawings here. So 1080. So then what do we get? We get the net capital at the end of the year. The net capital at the end of what? Of the year. So we have capital which is 163,080 plus 21,820 minus 1080, which will give us 183,820. And then to this we add liabilities. So always we start with the non-current liabilities. Because these are a sole proprietorship business, the only non-current liability which a sole proprietor may be having is a bank loan. Do we have a bank loan in this question here? No. So meaning that here we don't have any non-current liability. Finally, we record the current liabilities. For current liabilities, let's start with the what we have in the additional information. Additional information number number 7, where we have the income tax. That income tax was not yet paid, and that's why it is given as part of the additional information. If it had already been paid, then it should be part of the trial balance. So take into account it had not been paid, it will be one of the current liability. And then in the trial balance, we have the trade payables. We have trade payables of 15,6 what? 15,620. 15,620. Do we have anything else? Do we have anything else? No. So what we need to do here is we get now the total. We get the total. We get total, capital, and liabilities. Total, capital, and liabilities. So we add those three items: 183, 820 plus 3600 plus 15,620. And that is giving us the same figure of 203, 040 is what we have there, is what we have there. So that is it. That basically what was required in that particular part of that particular question. And equally the marks which were located there were how many marks? Were 3 marks. So those are the items now which were giving those 3 what? Those 3 marks. So that basically brings us now to the end of that particular topic relating to agriculture or accounting for agriculture activities, or accounting for farming activities. We have been able to discuss a number of issues. We have discussed what is biological asset, the recognition criteria, the initial subsequent measurement, and also we have looked on the financial statements prepared by an entity or basically a company involved in some farming or agriculture activities. Equally, you have looked on an illustration, and also there is another question which I've given as an assignment. Make sure that question which I've given as an assignment you attempted. So we stop at that point. See you in the next class as we discuss the next subtopic.
Hi there, my name is Patrick Kamau Kamure. Welcome to today's lesson of Public Finance and Taxation, where we look at the taxation of farming activities. So farming activity is somehow connected to the taxation of the business that in our previous lessons we have covered, because all matters is how is the farming activity carried out. Is it done by a limited company, a partnership, or a sole proprietorship? So when it comes to the taxation, determination of the taxable income, everything remains the same. So the only difference are just 2 things that you need to know. Additional taxable income in farming. Those are incomes that are specifically for farming, in addition to the one that we said are taxable under normal business, and also additional allowable expense. The one that we talked about are still applicable, and now they are those specific in farming because farming is a special activity. So I want to write something about the taxation of the farming activity here. Before then, at the end of it, we look at a question. This is what you need to know, that farming is also called agriculture. And it involves keeping of animals or growing of crops for food or commercial purpose. When farming is done, for commercial purpose, then the income generated become a taxable income. Another point is farming is taxed depending on how it is carried out, either in partnership, by a limited company, or by a sole proprietor, where it is taxed in the same way as these businesses as already covered. However, the following apply specifically in farming. So we have number one, the following specifically apply in farming. We have additional taxable income. This includes all incomes generated partnership, the way we have covered in our previous lesson. Determine the taxable income, then distribute the income to the partners, then tax them individually. Is it done by a limited company? It is a company, determine the taxable income of the company, then tax the company, just normally. Is it done by a sole proprietor, where you determine the taxable income of that sole proprietor, then tax him? However, we are saying the following specifically apply in farming: additional taxable income. Like that, any income that come out of farming activity, like selling of crops, livestock, animal produce. Animal produce are like eggs, milk, hide for the animals. All those are supposed to be taxable, and any other income that come out of farming activity. Then we have number two, additional allowable expenses. Additional allowable expenses. This include, we have A, costs of purchasing seed, fertilizer, and livestock. B, we have farm operation expenses. Such as cost of water, electricity, transport, etc. Then we have C, costs of clearing land and planting permanent and semi-permanent crops. D, costs incurred to prevent soil erosion. Soil erosion, i.e. construction of gabions, terraces, and making of windbreaks. The last one, capital allowance. Capital allowance on capital expenditure or farm work costs. This one, check capital allowance computation. So what we are saying is this: when you see these expenses and they are incurred in farming, treat them as a allowable expense. One we are saying is the cost of purchasing seeds, fertilizer, and livestock. In farming, they are allowable. Treat them as allowable expense. Farm operational expense, just like any other business, water expense, electricity, transport, and any other expense incurred in farming, allowable. Cost of clearing land and planting permanent and semi-permanent crops. Permanent crops are the crops that can be in the farm in the long term, like coffee plants, tea plants. The cost of planting them are allowable. Semi-permanent are like pyrethrum. They're usually in the short run, but 2, 3, 4, 5 years. They are all allowable. Cost incurred to prevent soil erosion, like construction of gabions, terraces, making of the windbreaks. All these are allowable as long as they are to prevent soil erosion. And capital allowance on capital expenditure in farming. Capital expenditure in farming is also called farm work cost. So when you see farm work cost, claim capital allowance under farming. And this I'm reminding you to go and check the capital allowance computation because we learned about it. Now at this moment, I'd like us to look at a question to see what we are talking about. So I read the question. This is what the question says. Mazao Ranch Limited practices mixed farming and milk processing. The following is the company's statement of profit or loss for the year ending that 1st December 2020. We have the revenues consisting of sale of milk, sale of livestock, sale of manure, proceed from the sale of an old tractor, discount received, expenses, which we have general expenses, construction of water tank, vaccine for livestock, loan repayment, depreciation, electricity and water, conveyance fee, construction of chicken sheds, animal feeds, salaries and wages, bad debt provision, repair and maintenance, professional fee, net profit. Additional information number 1, farm work acquired on 1st July 2020 comprised of the following: granary, labor quarters, cow sheds. Number 2, general expenses include subscription to a farmers association, acquisition of a 50-year lease, staff Christmas party, parking fine. Then number 3, repair and maintenance comprised, provision for fencing expenditure, repair to machinery, other repairs. Number 4, professional fee include 500,000 paid with regard to pursuing a dispute with the Kenya Revenue Authority, VAT department. Then assume corporate tax rate during the year was 25%. Required, adjusted taxable profit or loss for Mazao Ranch Limited for the year ending that 1st December 2020 and the tax payable if there is any. So in this case, we take note. Yes, it's a farming activity, although they are mixing it with processing, but the key thing is farming activity. And then the farming is done by a limited company. So whatever we have been saying about a limited company apply with addition of this additional taxable income we have talked about and additional allowable expense. So we treat it as a normal, it's a company actually. So the next question should be, which method are we supposed to use to get the taxable income? Like any other business, for this one we use the net profit method because we have been given the net accounting profit after the income statement. So this is how we go about it. For the year ended 31st of December 2020. So we start with net profit provided. which we have 157,000. Then when you are using the net profit method, we said you add non-allowable expenses in P&L and taxable operating income not in P&L. So just like we have been using the net profit method, we'll go through the P&L, look for the expenses that are not allowable in the P&L first. So which expenses are in the P&L? General expense. General expense we have been saying is allowable is for the business. Construction of water tank. We don't allow water tank, that's a fixed asset. So construction of water tank, a fixed asset we don't allow. Of which case we have 240. Had been deducted, isn't allowable. Next, vaccine for the livestock. That is allowable expense, vaccine, because it's a farm operational expense. Loan repayment. We said loan repayment is not allowed. What we allow is the interest on loan, not the loan. So we disallow that. Loan repayment, 350,000. After that, depreciation. Depreciation isn't allowable, so we add it. Depreciation, which you have 180,000. Electricity and water, that is allowable expense. Conveyance fee, no. If you go to the regular expense, we said conveyance fee is not allowable. And which we have 156,000. Then construction of chicken sheds, that's also a fixed asset, you know, a structure. We disallow. Chicken sheds, a fixed asset for 80,000. Animal feeds, that is an allowable expense. We said an operational expense. Salaries and wages is allowable. Bad debt provision. Provision we don't allow unless they are specific provision. So we disallow that. Bad debt provision, which we have 150,000. 150,000. Repair and maintenance, that is allowable, and also professional fee are allowed. From there, we go to the additional information we look for, an income not in P&L. If an income is not in the P&L, can only be in the additional information. And if it happens to be taxable operating, we add. And at the same time, we go there, we look if there is an analysis of the expense in P&L. In the analysis, if they do happen to be non-allowable, we add still. We start with the additional information, number 1. Farm work acquired on 1st July 2020 complies of the following. Now, farm work, that's a fixed asset. We said here, it's a capital expenditure. We don't allow capital expenditure. We claim capital allowance. But those expenses, if you look at them keenly, they are not in the P&L, so we cannot touch them. Then number 2, general expense include. Now, general expense is one of the expenses in the P&L, so we look for the non-allowable expense in it because it's an expense in the P&L. Subscription to Farmers Association, that's a trade association which we allow. Acquisition of a 50-year lease, that's allowable. We said up to 100 years, up to 99-year lease is allowed. Staff Christmas party allowed for welfare. Parking fine, we don't allow fine. So in this case, we disallow. Which we have 129,000. Then after that, we go to number 3. Repair and maintenance complies. Now, repair and maintenance is in the P&L. So we look for the non-allowable in it. Provision for fencing expenditure. We don't allow provisions. So we add provision. Only specific provision for bad debt do we allow. This provision for fencing, it's not specific provision for bad debt. For fencing, which we have 145,000. The other one is repair to machinery, that is allowed, together with other repairs. They are all allowable, revenue expenditure. Then we go to number 4. Professional fee include. Now, professional fee is in the P&L. If you go to the P&L, the last expense is actually the last one. Is in the P&L. We look for non-allowable in it. It includes 500,000 paid with regard to the pursuing dispute with Revenue Authority VAT. We said any expense relating to tax we don't allow. So we'll have a professional fee for VAT. $500,000. We don't allow. Number 5, assume the corporate tax rate during the year was 25%. That's not an income, it's not an expense. So we are done with an allowable expense in P&L, an income not in P&L. Unfortunately, we didn't come across any. Now we now come to the deduction. Remember, we deduct 3 items: non-taxable operating income in P&L or investment income in P&L and allowable expenses. Allowable expenses not in P&L. So first thing, we go to the P&L. We look for non-taxable operating income there. And also the same P&L, we look for all investment income there. Let's see. In the P&L, these are the incomes. Sale of milk. We said sale of milk is a taxable income. Taxable operating in farming. Income from selling of an animal produce. We said here under taxable operating income. Sale of livestock are taxable operating for farming. Sale of a manure, that's an animal produce, a taxable income. Proceed from the sale of an old tractor. Under normal circumstances, we don't tax income from selling fixed asset. That's a fixed asset. So profit on sale of tractor, which we have an amount of 820,000. We remove, not taxable. The other one is discount received. Discount received is a taxable operating under normal business. That's what we said. So since we are done, there is no other income in P&L that we have not considered. We now look for allowable expense not in P&L. An expense that is allowable that isn't in the P&L. If it is not in the P&L, then it can only be in the additional information. Let's see. Number 1, farm work acquired on 1st July 2020 comprised of the following. Now, farm work that is not in the P&L. And it's also not allowed. We said, what do? We claim capital allowance on farm work. Which one? If you go to the capital allowance we discussed earlier on in the previous lessons. So we said granary, that should be 50% without considering time. Even if it was from 1st July, we don't consider time. Labor quarters in farming, remember in farming, is supposed to be 50%. Now, cow shed, that's supposed to be another 50% without considering time. So we claim them. So we are continuing here. On that, we are looking for allowable expense not in P&L. So we have capital allowance. Capital allowance on, we start with granary, which should be 50% of 420. That will be 210,000. Labor quarters, 50% of 1,200. That will be 600,000. Then cow shed, 50% of 160. That will be 80,000. So we are done with number 1. We continue looking for allowable expense not in P&L. Number 2, general expense is in the P&L, including whatever is in there. Substitution, all of them are in the general expense. Repair and maintenance is in the P&L, including whatever is in there. Professional fee is in the P&L. 5 is not an expense. Now that we have not been given capital allowance, and that's the reason why we are computing, you have to come back here and now look for fixed assets so that now you can finish on the capital allowance. We had construction of water tank. That is a structure construction. So that's supposed to be 50%. It is a structure in farming. The other one is construction of chicken sheds. That's another 50%, a structure in farming. And this fencing, if it was not a provision, provision means that they have not yet incurred. They are providing they are going to incur. We don't claim capital allowance. But if it was incurred, we could have claimed 50%. And there isn't any other fixed asset. So you'll come here, a water tank construction of, we have tank, which is supposed to be 50% of 240. That will be 120,000. The other one is chicken shed, construction of chicken shed, which should be another 50%. Chicken shed we had for 80. That will be 240. And since there is no other fixed asset and we are done with the allowable expense not in P&L, we get the net taxable operating incomes. So we are going to take this, add, and then minus. So we start 157,000, and then we add to 40,000. We add 350,000. We add 180. We add 156. We add 480. We add 150. We add 129. We add 145. We add 500. And then we minus the 8, it was 820. We minus 210. We minus 600. We minus 80. We minus 120. And we minus 240, which we have 417. So this is 417,000. Now note, this was a company, limited. So we said company, since it is taxed on its own income, we add the taxable investment income. Investment incomes. But if you look at the question, in the income statement, these were the income. Sale of milk, sale of livestock, manure, proceeds from old tractor, discount. There is no investment income. So this would be a dash, meaning the total taxable income. Total taxable income would be the 417,000. So that mark the end of required one. Adjusted taxable profit or loss of Mazao Lunch Limited for that year. Number 2, tax payable or on profit or loss. So in this case, we say this is a company. We said like any other company, corporation tax rate. That we have not been told is an unresident or a foreign company, 30%. So we'll say tax would be 30% of 417,000, which will give us how much? 30% of 417. That gives us 125, 100. And that is the end of that question. So that is how you tax the farming activity. And you would have noted that it's not different from the businesses that we have looked at. You just consider it like a normal business. Sole proprietorship if it's done by a sole proprietor. A partnership is if it's done under partnership. A limited company like the way we have done it there, then you just tax it that way. The only additional thing that you need to know is this additional taxable income and additional allowable expense. So that marks the end of the taxation of the farming activities. And I would want you, below this video, there is an assignment. Kindly go through it, look at it, attempt it, then see if you can be able to do it the way we have done ours here. So for today, we end there. Thank you very much.
Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. Today we're going to study the legal audit as a subtopic under the chapter on Introduction to Corporate Governance. In our last session we discussed the compliance obligations. Today we're moving on to legal audit. By the end of this lesson, you should be able to define legal audit, should also be able to explain the importance of or the objectives of legal audit. Legal audit. Remember in our last session we said that compliance is the process of adhering to rules, regulations, and laws. We also mentioned that a company should put in place a system to monitor and check if the company is adhering to rules, regulations, and laws. And legal audit then is defined as the inspecting or the inspection of the company's activities, transactions, and practices to establish their compliance to its constitution and with the applicable authorities. Legal audit is the process of inspecting the company's activities, transactions, and practices to establish if the company is adhering to laws, regulations, and rules that are applicable to the company. It can also be defined as the systematic review of the company's transactions, contracts, and practices to establish its legal status and identify the potential legal problems. It may also help minimize its legal liability. So the main purpose of a legal audit is to help the company minimize risks and potential legal liabilities. It focuses on subjects like the form of business organization, the review of taxation law compliance, a review of intellectual property issues, use of internet, the human resources, among other areas, though legal audit covers such areas. So I've defined legal audit candidates as the inspection of the company's activities, the company's practices to establish their compliance to laws, regulations, and rules. It is the inspection of the company's activities, the company's transactions to establish compliance with laws, to establish compliance with laws. It is the inspection of the company's transaction to establish compliance. All right? It is the systematic review of the company's transactions. It is the systematic review of the company's transactions, the company's contracts, and practices to establish its legal status and identify potential legal problems and help minimize its legal liability. So let's now study the objectives. What are the objectives of legal audit? Objectives of legal audit. Objectives of legal audit. Now, objective number one, candidates, is that legal audit promotes accountability. Promotes accountability. Legal audit does what? Promotes accountability. By doing what? By reporting deviations from violations of authorities so that corrective action may be taken by the company. Because when you are carrying out a legal audit, you on one hand have a list of the requirements, the legal requirements, then you check if the company has complied, you tick, right? With this one, complied. Number 2, complied. Number 3, not complied. So it's a systematic review of the transactions of the company. It does what? Promotes accountability. When review is carried out, when the activities are compared vis-a-vis the requirements, then it's possible to identify areas that have not been complied with. So the legal audit will identify deviations, and that promotes accountability. 2, identifies the company's legal liabilities. A legal audit can help identify a company's legal liabilities and risks beforehand. And risks beforehand. It helps, in other words, identify the potential liabilities and risks before they come up, all right? And if it's possible to identify legal liabilities and risks beforehand, then the company can come up with a way of averting potential lawsuits and penalties. And that is a sure way of saving the company's money in litigation costs and other unnecessary expenses. The third objective of a legal audit is that legal audit helps the company become or remain compliant. Helps the company remain compliant. It helps the company to remain compliant with the laws and policies that are put in place as it exposes the laws that have not been complied with. And that provides a way of complying with the laws that have not been complied with. Because when you carry out a legal audit, it's possible to identify the laws that have been complied with and the laws that have not been complied with. So the laws that have not been complied with, they can now be complied with as a result of carrying out a legal audit. 4, promotes good corporate governance. A legal audit promotes good corporate governance, both by identifying the weaknesses and deviations from the law and regulations, and by assessing propriety. All right? It promotes good corporate governance by, 1, identifying weaknesses and deviations from laws and regulations, and by assessing propriety where there are insufficient or inadequate laws and regulations. And when that happens, then fraud and corruption are by their very nature elements which counteract transparency, accountability, they counteract good stewardship, and so on. So good legal audit promotes good corporate governance. Then number 5, a legal audit also demonstrates that the company's directors and managers have carried out due diligence. Due diligence. By carrying out a legal audit, that demonstrates that the management has done what? Has carried out what we call due diligence with regard to the activities undertaken, thereby minimizing their exposure to personal liability. When the directors conduct a legal audit, that legal audit helps the company to carry out due diligence. That demonstrates that the directors have done what? Have carried out due diligence with regard to the activities undertaken by the company, and that minimizes the exposure to liability, minimizes exposure to directors' personal liability. When directors carry out a legal audit, then they are reducing the possibility of personal legal audit, because they would have conducted their work as required by laws, as required by regulations, rules, policies, and so on. So these are 5 objectives of a legal audit, and that will mark the end of the lesson. Remember, the objective of this lesson was that by the end of the lesson, you should be able to define legal audit and explain the objectives of a legal audit. And that will form the basis of your today's assignment. Define a legal audit. 2, highlight 5 objectives of a legal audit. That is your assignment. When answering the question, ensure that you do not directly refer to the notes. See if you can recall what you have learned in today's lesson from your memory. Thank you. God bless you. Bye-bye. Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In today's lesson, we will study the role of stakeholders in corporate governance, the role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to 3 stakeholders. Number 1, the shareholders. Number 2, the board of directors and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority, because shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number 1, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly downwards, held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation, where the shareholders have appointed the board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors. To change the composition of the board of directors. To change the composition of the board of directors that does not perform to expectation. all right, that does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board, so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership. Board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation. To determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with the what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. They come up with strategies, but the implementation is carried out by the management. And therefore, the board of directors has a role to monitor and evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance. Policies and management performance. These directors are monitored by shareholders, and these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws. To ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, the code of corporate governance. which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates, is to ensure the corporation communicates with stakeholders. To ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders. The government, the shareholders, the financiers, the customers, and all that. There has to be proper communication because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are seven roles. Let me add another one, 8. Regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the Chief Executive Officer of the company. And they should at least also participate in the appointment of senior management to ensure that, to ensure the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, we have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the corporation. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say, that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. Identify the key risk areas and also the key performance indicators and key performance indicators. Key performance indicators of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. As what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. the government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation and the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that the public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. provides a general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders, because you know corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals. Who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance: A, shareholders; B, board of directors; C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video, try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye.
Hi there. So welcome back to Manifested Online Classes. So in this session, I want us to look on an illustration question regarding accounting for leases by the lessee. And recall what you have said in our previous session, that the lessee is supposed to recognize two items in his books of account: the right of use asset and the lease what? Liability. So I want us to look on an illustration question here. We look on how we determine those two items: right of use asset and the lease liability. So the question reads, or the illustration reads: on 1st of January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for 3 years period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on 31st of December 2019. Initial direct costs incurred in the lease amounted to 30,000 and were paid by Breakwood Limited. The plant and equipment had a remaining economic useful life for 5 years at the inception date of the lease. The lease contract did not contain any purchase option for the lessee. And then you're told Breakwood Limited can borrow at an interest rate of 10% per annum. So we are required to analyze the accounting treatment of the above lease transaction from the inception for 3 years period of and there is what? A contract. So basically, what you're told in this particular illustration here is that the company, which is called Breakwood Limited, leased an asset. So what that means, that Breakwood Limited is the lessee, is a company which has been conferred, is the company which has been given the right to do what? To use an asset for a given period of time. And I think in this case, we are told that this company was given the right to use the asset for a period of 3 years, from 1st of January 2019 to or basically up to the end of the 3rd year. So what you have said is that once a company leases an asset, at the inception date of the lease, or when the lease commences, such a company should recognize two items: something we have referred to as the lease liability, and number two, what we have referred to as the right of what? Use asset. So therefore, let's determine those two items. And we are going to start by determining the lease liability. The lease liability, and that is on 1st of January 2019. 1st January 2019, this is the inception date of the lease. Inception date of the lease. And you have said that this is equal to the present value of the lease, or the minimum lease rentals, minimum lease rentals, present value of minimum lease rentals not paid at inception date of the lease, not paid at inception date of the lease, inception date of the lease. So for us to be able to compute this, we have to understand what you're told in that particular question there, that this particular lease commenced on 1st of January 2019. So 1st January 2019, this is the inception date of the lease. It is the date when the lease commenced. So, and you're told the lease is for 3 years. The first year will end on 31st of December 2019, 31st of December 2020, and 31st of December 2021. 31st of December 2021. And we are told that the rent which is payable, the minimum lease rentals which is payable, is an amount of 500,000, and we are told that the first rent will be paid on 31st of December 2019. What that means is that this minimum lease rentals is payable at the end of each year. Payable at the end of each what? Year. It means that the other minimum lease rental, so the other rent will be paid at the end of year 2, and the other one will be paid at the end of what? Year 3. At the end of what? Year 3. So therefore, how do we determine the lease liability? We determine the lease liability by getting the present value of the minimum lease rentals not paid at the inception date of the lease. So in our case here, the minimum lease rentals which has not been paid on this date include this amount, that, and what? That. So therefore, the lease liability is equal to the minimum lease rentals, which is an amount of 500,000, and basically this is like an annuity, is a series of payment. We need to multiply that with the present value, interest factor of annuity, at which rate? At the rate which you are given there. In the last paragraph of that question, you are told that this company, which is Breakwood Limited, can borrow at the rate of 10%. That's what we are going to use for discounting purpose, and basically for period of 3 years. So we multiply that with the present value interest factor of annuity at 10% for what? For 3 years. So therefore, we have 500,000. So we need to get the formula for getting this, where we take 1 minus 1 plus R. Our R in this case is 10%. So this will be 1.1 raised to power n. Our n is what? 3. And then we divide that with what? With R, which is 0. What? 0.1. So basically this is a formula which we use in terms of getting the present value, interest factor of annuity. So we take what? 1 minus 1 plus what? Plus R raised to power negative n, and then we divide that with what? With R. So that is now what we are using what? Here. So therefore, let's get that lease liability at the inception date of what? At the inception date of the lease. So let first of all we compute this, and we take 1.1, we raise that to negative 3, and then we deduct that from 1, and then we divide that with 0.1, and then times 500,000, and that will give us a figure of what? That will give us a figure of amortize this particular what? Liability. So we amortize that liability by preparing something called the lease amortization what? Schedule. So we need to prepare something called a lease amortization schedule. A lease amortization schedule. Lease amortization schedule. So how do we prepare this schedule? We always start with the years which are ending on 31st of December. So and basically we know that the first year was supposed to end on 31st of December 2019, and then the other column here will be for the lease liability. Lease liability at the start of the year, that is balance brought down. Then the next column which follows here always depend with when the rent is payable. If the rent is payable at the start, the next column should be for the rent paid. If the rent is payable at the end of the year, the next column here should be for the interest. So mean that because our rent here is payable at the end of the year, our next column here should be for the interest. And basically this interest we computed based on the rate of 10%, based on the rate of 10%. And then the other column here should be for the lease rentals paid, or in other terms you can just refer to this as cash paid. Cash what? Cash paid, which now represent the rent paid at the end of each year. And finally we have the lease liability. The lease liability at the end of what? At the end of the year. So that's how we prepare our amortization schedule. Our amortization schedule. So in our case, we have said the first year ended on 31st December 2019. The other year ended on 31st of December 2020. And the other year ended on 31st of December 2021. So what is the lease liability at the start of year 1? So the lease liability at the start of year 1 is what you have determined there. the amount of 12, 43, 426. So then we compute the interest, which will be 10% of this. 10% of this will be 12, 43, or 124,000, 343. And then we know that at the end of year one, how much cash, or basically how much rent was paid. So at the end of year one, the rent which was paid was 500,000. Was 500 what? Thousand. So how do we get then the lease liability at the end of year one? To get the lease liability at the end of year one, we take the lease liability at the start of the year, plus the interest, and then we less cash which was paid. So that will give us the lease liability at the end of what? At the end of year one. So we take 1243, 426, plus 124, 343, and then we less 500,000. We less 500,000, and that will give us now a lease liability of what? Will give us a lease liability here of 867, 769. So we can confirm whether that is correct. We take 1,243,426 plus the interest 124, 343 minus what was paid, which is 500,000. 500,000. Yes, that will give us 867, 769, which now will be the lease liability at the end of year one, and equally that now will be the lease liability at the start of year two. So we compute interest being 10% of that, which will give us 86, 777, and then the cash which was still paid in that year was how much? Was 500,000. So let's work out the lease liability at the end of year two. So we have 867, 769 plus the interest, which is 86, 777 minus 500,000, and that will give us a figure of 454, 546, 546, and then that now will be the lease liability at the start of year 3, 454, 546, and then we get 10% of that, which now will be our interest, which will be 45, 455, and then we less now what was paid. So what was paid at the end of year 3 is what we have there. So and then we get now the lease liability at the end of year 3. So which will be 454, 546 plus 45, 455 minus 500,000, and basically that now will give us what? 0. It will give us what? 0. So that's how we prepare what we refer as the lease amortization schedule. The lease amortization schedule, of which the objective, the purpose of preparing that lease amortization schedule is for us to be able to amortize this particular word, lease liability. And what now the lessee should account for in his financial statement is that this particular lease, or basically this interest which we have here, this one is accounted for as an expense in the income statement of the lessee, is an expense in the income statement of the lessee, and then this particular lease liability is or is basically a liability. Is what? Is a liability in the statement of financial possession. This one is recognized as a liability, in the statement of financial possession of who? In the statement of financial possession of the lessee, So then next what we need to do is to determine the other item, and the other item we need to determine here is what? Is the right of use asset. The right of use what? Asset. Right of use asset. Right of use assets, and we need to determine the right of use asset at the inception date of the lease, which is the 1st of January 2019. 1st of January 2019. Remember, we have said that we determine fees by adding three items. One, there is a liability at the inception date of the lease. Remember, you have already determined there is a liability at the inception date of the lease. To that, we add any payment which was made before or at the commencement date of the lease. Plus, also we add what we refer as any initial direct cost associated with the lease. So, therefore, what we do here, we take the lease liability. There is liability at the inception date of the lease, that is on 1st of January 2019, and we already have that figure here, which is 43 426, and then to this we add payment made at or before the commencement date of the lease. Commencement date of the lease. Commencement date of the lease. So if you check on this particular schedule which we have here, you'll be able to see that we don't have any payment which was made here. No payment which was made before or at the commencement date of the lease. But if this rent, this minimum lease rentals was payable at the start of the year, then the amount now which would have been paid at the inception date of the lease or basically before the commencement date of the lease would be now the rent which was paid at the start of or at the commencement date of the lease. So therefore, in our case here, we don't have any payment which was made before or at the commencement date of the lease. And then to this we add the initial direct cost. So this is any cost which was incurred at the commencement date of the lease. If you go back to the question there, to our illustration, in paragraph number 2, we are told the initial direct costs incurred on the lease amounted to 30,000 and were paid for by Breakwood Limited. So in our case here, we have some initial direct costs which were incurred on the commencement date of the lease and which amounted to how much? Which amounted to 30,000. So we add it there. So whatever you get here, we refer to that as the right of use asset. The right of use what? Asset. So let's add these two figures, which will give us 1273 426. 426. That is now the right of use asset at the commencement date of the lease. Then what you have said is that this particular right of use asset then should be depreciated at the shorter of two periods. At the shorter of two what? Periods. So this one should be depreciated. Right of use asset should be depreciated at shorter law of number one, the lease term. So in this case, when talk about the lease term, we are talking of the period of the lease. So in our case, we know this lease is for what? For 3 years, or Roman 2, economic life of the asset. Economic life of asset. So are we given the economic life of the asset in this particular question here? Yes. So we are given the economic life of the asset in paragraph 2, sentence 2, where we are told the plant and equipment had a remaining economic useful life of how many years? 5 years. So we are given the economic life of the asset, which are 5 years. So therefore, what we need to do is to depreciate now this particular right of use asset at the shorter of those two periods. At the shorter of those two periods. So which period is shorter? The period which is shorter is the lease term, which are 3 years. So therefore, to determine the depreciation per annum, per annum of this right of use asset, we take the amount for initial recognition, which is 1273 426, and then we divide that with 3 years. That will give us now the amount to be recognized as depreciation in each of those 3 years. So 1273 426, divide that with 3, and that will give us annual depreciation of 424,475. 475. So that is now the amount to be recognized as what? As an expense, or basically as depreciation in each of those 3 years, in each of those 3 years. And then this particular right of use asset, in each year, it should be depreciated at that particular amount, at that particular what? Amount. So therefore, that is basically what the examiner here was requiring. You illustrate how this particular lease will be accounted for that particular period of 3 years. So what you are supposed to do there is to remember that the lessee, the company which has leased this particular asset, will recognize 2 items: the lease liability, and we have looked on how we determine that, and then which you have said should be amortized over the term of the lease. And 2, the lessee, that is Breakwood Limited, will also recognize what you have referred to as the right of what? Use asset, and then that right of use asset should be depreciated over the term of the lease, or basically at the shorter of those 2 what? Period, the lease term and also what? The economic life of the asset. So that what is required as far as that particular illustration is concerned. So that brings us now to the end of how the leases are accounted for by the lessee. So we take a short break, and then once we come back, I want us to look on how we or how the leases are accounted for by the owner of the asset, or basically the person who is called the lessor. So we take a short break, and then see you in the next class.
Hi there, my name is Patrick Kamau-Kamure, your lecturer in advanced taxation. So I welcome you today to the lesson where we look at a topic called tax investigation. And under the tax investigation, we are going to look at the back duty and in-depth investigation. So when we talk of the back duty, we are talking about the tax that is in arrears, or that was in arrears. Back duty, you know, the tax, the duty that is backward, the one that was supposed to be corrected by the KRA from the taxpayer, but it wasn't corrected. So what the KRA normally do, they normally come and look at your books of account, and they do a thorough investigation in order to determine your tax position. So in this case, we want to see how is that investigation usually done. In this case, what you also need to understand is that when you talk of the back duty, or the tax that is in arrears, and in which case an in-depth investigation is usually done. So in this case, what normally happens is that KRA usually have to come and look at your books of account and determine the taxable income. The taxable income of each of the years. So taxable income in that, if for example you are under investigation for 5 years, so they have to determine what is the taxable income of the first year, what is the taxable income of the second year, third year, fourth year, and the fifth year. And once they determine the taxable income of each of those years, then they multiply by the tax rates. If it is a company, 30%, and then they can be able to get the tax that you are supposed to pay. If you are an individual, then it is graduated, because we know that individuals, it is usually on graduated scales. So it is graduated to determine now the tax that you are supposed to pay. So in this case, we should ask ourselves then, what normally costs the tax that is in arrears? What normally costs the back duty? It is usually as a result of majorly 3 things. 1, non-declaration of taxable income, where the taxpayer didn't declare the taxable income for those particular period at all. So the KRA would have come and now determine the taxable income for each of those years. 2, under declaration of the taxable income. It means that you didn't declare the correct amount of the taxable income. For example, you have been earning, let's say, 100,000 per month, but instead of declaring that, and remember we normally declare when you are filing the returns, instead of declaring the 100,000, you declare 50,000 every year. So that means that the KRA will tax you on 50,000. So the 50,000 that you have not declared, that would amount to the back duty when it is taxed. So another one we have where the taxpayer have been over declaring the allowable expense of the business. So remember, expenses normally reduce the taxable profit or income of the business. So if the expenses are overstated, then the taxable profit automatically will come down. So in that case, that means that if the profit is less, then the KRA will come come and investigate. Why have you been under declaring the over declaring the allowable expense or under declaring the taxable profit? So in this case, then that means that when they do the investigation and determine the correct amount of the expense you are supposed to deduct, because now you have been over deducting, then that means that this would amount to the tax in arrears, or what we call the back duty. Now, when the in-depth investigation is usually done, the KRA normally use one item to do that. We call it the capital statement. And capital statement, as we are going to see, it is used when we have more than 1 year. The taxpayer has not been declaring their taxable income for more than 1 year, and we are going to see how that capital statement is used to determine the taxable income of the taxpayer. So before we go very far, I'd like us to write something on that. That back duty refers to the tax in arrears. In arrears, that is the tax that was supposed to be paid in the past years, but it was not paid. The tax in arrears is usually determined using by the KRA, determined by the KRA by doing an in-depth investigation. In-depth investigation is where KRA take a look at all books of account of the taxpayer to determine the correct tax position. Another point is that back duty stroke tax in arrears can be as a result of the following. 1, non-declaration of taxable income. Number 2, under declaration of taxable incomes. Number 3, overstating of allowable expenses of the business. And the last one I want to add here is claiming expenses or relief, one is not entitled to. One is not entitled to. So another point that you need to know is that when determining the tax in arrears, stroke back duty, the commissioner will determine the taxable income of each year from where the tax in arrears will be computed through computation of taxable income and tax rate applicable for the years of income for the taxpayer and the year of income. We say another one is that determination of taxable income where investigation involves several years is done using capital statement. So it's good to know we have talked about capital statement there. And we say capital statement is used where no proper books of account have been kept by taxpayer. It involves comparison of assets and liabilities of business to determine the capital or net assets or net assets or net assets, after which growth in capital net asset is used to determine taxable income. Capital statement which is used to determine the taxable income has the following format. So I already have explained to you what that means. However, we are saying now, where no proper books of account have been kept, the taxpayer normally use the capital statement, or KRA will use the capital statement to determine the taxable income of the person. Now, once they get the taxable income, then they'll just compute the tax payable by multiplying with the corporate tax rate or the graduated scale rates for the taxpayer, in case it is an individual like those in sole proprietorship or those in partnership. So we are saying that capital statement is usually prepared by comparing assets and liabilities to determine the capital or the net assets, after which the growth in capital or growth in net assets would then be determined, and from there now the taxable income would be determined. So capital statement, we are saying, has the following format. So I'm going to draw for you the capital statement there, see how it is used to get the taxable income. So I leave this space because of the structure of the capital statement, and utilize the space on the other end. So this is how capital statement look like. We have the capital statement. We have the items, and then we have years, which we have year 1,